Yes, Cathie just dumped 13.5 million shares of Palantir. If that scares you, you should ask yourself if you're in the stock for the right reasons. Look, there's really only one reason to buy a stock, but there's thousands of reasons to sell it. Cathie has been beat up pretty badly by the media of late. Everyone is piling on. She was Wonder Woman last year up until September 2021. Now she's the Black Plague and no one will touch her except to criticize her. That should tell you something about the media if you haven't already learned it. Again, if you own Palantir and Cathie's selling of 13.5 million shares of Palantir last week has you terrified and feeling betrayed, you really have to reconsider your stock selection process and ask yourself, did you buy it because Cathie did, or did you buy it because the stock analysis process you rely on indicated a strong buy signal? Hopefully for you, it's the latter and not the former. ARK Invest ETFs are down nearly 52% or more this year, and many people that were drinking the Kool-Aid last year without regard to a stock analysis process and bought in deep with that fund have been getting hammered, and some now are running and jumping ship because they're scared. Now, I don't know for sure why Cathie is selling 13.5 million shares of Palantir, but if some people want their money back out of some of her ETFs because they lost faith, Cathie may need to get cash quickly and liquidate those 13.5 million shares to come up with that cash. I'm not saying that's the case, but it could certainly be one of 1,000 reasons. The moral of this story is this: you shouldn't panic if Cathie is selling if you had a sound stock analysis process for buying the ETF. Now, if you only bought because you were romanticized by Cathie's story, then that may be a problem. That's like buying a stock because Warren Buffett and Charlie Munger own it. That's not a reason to buy a stock. Berkshire Hathaway is a mammoth company. As a matter of fact, if it was broken up, it would be worth more in individual parts than it is as a whole. Warren's great superpower is his M&A skills, not necessarily his stock picking skills, even though he's not bad at it. He bought and sold Walmart too early. He exited Costco too early. The Kraft purchase was a disaster. Here are some other stocks owned by Berkshire that have been hit pretty hard, but who hasn't, right? Liberty Latin America, U.S. Bancorp, Biogen, Bank of New York Mellon, Bank of America, SiriusXM, Store Capital, Liberty SiriusXM, and Globe Life. But I could say the same thing in my portfolio, right? So the market's down overall. So these stocks are down. Does it mean they're down forever? No, this is a snapshot in time. Each of these could improve or decline over the next 3 to 5 years. Berkshire owns a lot of companies. Those businesses throw off a lot of cash, and Berkshire does their best to reallocate that cash in a way of smart dividend plays and a few stock purchases that add billions more dollars to their pot of gold so they can have a bigger pot to buy more great companies. Berkshire is big enough and sitting on enough cash to wait for the right deal to come along. They're also limited in places that Buffett can actually place money today because it is so big. When Buffett takes a position and buys millions of shares, he doesn't need a significant uptick in the stock to gain an advantage in share price or dividends. He's playing the law of large numbers. The small retail investor isn't playing the same game. The small retail investor just doesn't have the same problem as Buffett. Buffett has to always make sure he stays under that 10% ownership threshold of stock ownership of certain stocks a company he buys into. If not, it begins to, well, in many cases, make him an active investor in the sense of voting power within a company, and there can be significant tax consequences of ownership above 10% because his voting power increases, which give him the ability to influence the board. So even if he wanted to buy more, he couldn't unless he had a strategic means for doing so that could offset the tax consequences. Now, Jim Simmons is a stock trader, and he's probably better at buying and selecting stocks than Warren is, but they're two totally different type of investors with totally different investment styles that have served them both very well. Neither man is crying on the way to the bank. Investors like these guys, well, they play in a league above, and in a league the small retail investor is incapable of playing in. Our goals are different. If Warren was a small retail investor, his strategies would be much different than they are today. With Berkshire's size, he can't be as nimble in the market. When Berkshire makes a move, left or right, up or down, the market reacts. Berkshire is a market maker now, so it has much more limited buying opportunities than that of retail investors. So what does all of this have to do with Cathie Wood selling 13.5 million shares of Palantir? Well, last week I completed and released a recap of Palantir's Q4 2021 earnings call that I stayed up way too late to record, working on 2 back-to-back YouTube video releases. You could tell it was late because for some reason I started calling Alex Karp Michael in the video. It's crazy. Anyway, in my recap, I give my updated take on Palantir as its numbers demonstrated, not what the talking heads are saying, because I realized early on in my investment career that Talking heads have a motive, and they're not working for the retail investor. Over the last couple of years, Wall Street was whining that Palantir had too many eggs in the government basket, so they beat them up. So Palantir, now more secure and proven enough in the USG sector, pivots to extend to commercial. And guess what? Revenue actually grew 47% year over year, Q4 2021, in the commercial sector, and Wall Street's even more pissed. And what happens to the stock? It drops below $12 per share. There's a number of things I don't like about Palantir, and I spell those out in my 4-part Palantir comprehensive stock analysis on my channel. And if you haven't watched those, I'd encourage you to take a look at my process of analyzing Palantir and compare it to your personal insights. Would I put all of my eggs in the Palantir bucket? Absolutely not. It doesn't fit my criteria. Keyword my. And secondly, I wouldn't do that. There's no way I'm betting the bank on one single company. Do you know how lucky you would have to be to pull that lottery ticket? Sure, someone will win the lottery. Somebody does every year. But I will take a well planned out process along with a little luck any day. Sometimes it's okay to be a slow lane millionaire. I'm okay with hitting singles and doubles and occasional triple and a home run every once in a while because a really great pitch comes across the plate, like it did for Buffett when he purchased Coca-Cola after Black Tuesday, October 19, 1987, when a market error shot fear through the market and started the sell-off. I'd much rather take my chances on searching for great companies and buying deep as the market puts them on sale every year than betting the farm on hope. Is Palantir a great company today? In my opinion, not yet. Will they be someday? I don't know, and no one knows. And if anyone says they know, hold your money tight and run away as fast as you can. Even though Palantir has been around since 2003, it's still new in its market traction. In my opinion, it has nearly completed its construction of its foundation, which it could now potentially build on. I've said this before, you don't have to get in on the ground floor to get rich in the stock market. To me, that requires way too much luck. Wall Street makes billions yearly on the unlucky. I'm not saying you have to win on every stock pick, because you don't. I haven't won on every stock pick over my years investing, but I've also never bet the bank on any single company. But if you do place your bet on companies like Palantir early, you'd be wise to heed the words of the author of Dan Doe Investor, Monish Pabrai, when he encourages you to invest in a way that heads you win, tails you lose a little. The point is, stop following the celebrity investor and start identifying a solid investment process and follow that instead. It will be more in line with your financial and investing goals and the amount of cash you have available to invest. And as you have larger sums of money accumulate in your account through good investing, you'll notice your investment principles will remain pretty much the same, but your tactics will change. The basic premise of what Cathie is spouting is good. Innovation needs cash, but not all the innovations her team is promoting are worthy of my hard-earned dollars today. Look, I didn't buy Amazon until it was $700 per share. Was I too late? No. Were there some people that got in early and hung on? Sure, there were a few, but most of them were gone by the time the stock hit $100 per share back in 2009. The first time it hit $100 per share was back in April 1999. It would take nearly 9 years for it to climb back above 100 a share again. How many investors do you think hung on during that long 9-year stretch? How many people had the vision for Amazon back when the technology infrastructure and economic environment for it was not visible yet? Most people had no concept that Amazon's real secret weapon was AWS until way later. I was one of those, but once I understood it, I was in. Most of what people, especially new retail investors, make their buying decision on is kind of a fringe stretch of the meaning of what Nissan Taleb, the author of Black Swan, calls Black Swan events. A black swan is a metaphor describing an event that comes as a surprise and has a major effect, and retrospectively is often inappropriately rationalized. In other words, humans often make decisions today based on hindsight, and as you know, as far as a lens looking towards the future, hindsight doesn't provide 20/20 vision. What I mean by this is that some people think because Amazon and Tesla did it, then Palantir will do the same. So if they buy it early, they'll be multimillionaires sometime in the future. But that's a huge leap of faith into the abyss. Yes, times have changed and the rules for money have changed temporarily because the feds have made money so cheap since 2008. Also, the fact that due to the trading platforms like Robinhood, barriers to entry into the market for investors has come down significantly. It has even forced big companies like Schwab, Fidelity, and others to lower their barriers for entry into the stock market, which has brought many more retail investors into the market than at any point in time in stock market history. And one of the biggest benefactors of that shift has been Palantir. It currently sits with over 60% of its shares owned by retail investors and only about 24% of the shares owned by institutional investors, which makes sense why Alex took several calls from retail investors during the recent Palantir Q4 2021 earnings call. As Palantir continues to build and grow, it will become something much different than maybe even it thought. We just don't know what that is right now. Retail investors are the lifeblood of Palantir, and if their bet is right, it will be another monumental mark in the historic shift in investing for the stock market. Just as a side note, the total share distribution of Tesla today, 41% institutional investors, 20% Tesla insiders, and 38% retail investors. AMC and GameStop were meme stocks, promoted on purpose, for a purpose, and a lot of new investors got busted up on those stock picks, while others got really rich on the same stocks, just as what's happened with buying the wrong crypto and NFT bets. The siren call of easy money can be too much to resist when you're an inexperienced new investor. Be patient. Remember, there's two ways to learn: from your own experience or from the experience of others. The latter is far less expensive. So if you have a solid stock analysis process that led you to Palantir and you're over positioned in it within your portfolio right now, you'll probably be okay given some years. If you're getting in now because you can clearly see the market has mispriced the stock and you want to take the run up over the next 5 to 9 years, make sure you're doing it for the right reasons that fits your risk profile for your portfolio goals. Come on, Wall Street. Palantir opened up September 30th, 2020 at $9.50 a share. You mean to tell me today, with the number of USG and commercial contracts is added since that time, trending revenue growth done created by a skeleton sales force, positive free cash flow, barely a European market, a move to modularization of their platform that makes it easier for IT departments to adopt and deploy, and you're trying to convince me they're only worth just over $11 a share today? I'm not buying it, even if Cathie is selling 13.5 million shares. You can do better than that. If you found value in this video, click the thumbs up and subscribe. Thanks for watching. I'll catch you in the next video.